So we get a dire warning from Goldman Sachs as the market's hitting new highs and we've seen returns like none other. Could this be the lost decade of returns moving forward? And Warren Buffett just adds into an interesting position that we're going to review really quick. Along with that, I want to talk about what's taking place with the healthcare providers. I'm talking about United Healthcare, Cigna, and CVS. Something is brewing. I don't necessarily think it's a good thing. Now, I've been a bull on CVS and I've definitely been fairly wrong. My initial analysis was that I thought this was a buy between $52 to $56. The stock shot up to around $65 a share and is now floating back down to $60. And we're going to go over where I think the problems lie and what is taking place with that as well. If you like this type of fundamental analysis, make sure you like and subscribe, and welcome into Compounding Capital. Now, Goldman Sachs comes out with an interesting article, kind of a contrarian thought process here, as more and more people are becoming bullish and we're seeing the retail participation rate with stocks start moving to levels of dot-com bubbles. Interesting enough, as participation picks up, more and more euphoric comes into the market. Now, with valuations being pushed higher, a couple different things could take place here. Could we see a market correction, a mean reversion? Could we see multiple years of lagging returns, which is kind of what Goldman Sachs is putting out there? Or could we grow into our valuations before we get a correction? Now, I'm in the camp of I do think a recession is coming, and I can definitely see the case of bonds being a little bit more interesting at these levels. When we're talking about an S&P 500 trading at a forward P around 22 times, and we're seeing that 10-year now creep up above 4%. If Goldman Sachs is stating that future returns are probably going to be sitting around 3%. That's with a risk, mind you. Equities are risky investments. But is there something to be said about what Goldman Sachs is saying here? Investors should be prepared for equity returns during the next decade that are toward the lower end of their typical performance distribution relative to bonds and inflation. Goldman also sees stocks struggling to outperform other assets over the next 10 years, and we're already starting to see things like commodities really start to tick up here. We've talked about the gold trade. We've talked about specifically Barrick Gold being an underperformer around $15, $16 a share, and where is that stock trading right now? It is up 28% over the last 6 months. I called this one out around $14, $15 a share, and it has run extremely well because the underlying asset of gold was skyrocketing up over 40%. And I saw the opportunity for these gold miners to start catching up to the gold trade. And I thought this was an interesting play. The one thing Goldman Sachs really highlights here is the market concentration. And when we're talking about concentration that we have to go back over the last 100 years, we know that it's probably too over concentrated at this point in time. Now on this channel, I definitely recommend just dollar cost averaging into a broadly diversified index. Set it, forget it. Don't get involved in these individual nitty gritty type of things. But Goldman Sachs is pointing out something that makes me personally interested in individual equities at this point in time. I think when we look at the market as a whole, there's about 10 names carrying this entire market. Goldman Sachs is bringing this to our attention, saying that this concentration as it is at basically a 100-year level. And that's usually never a good thing. When you only have a few different names really pushing up the market, I personally am a contrarian investor looking underneath the hood at opportunities that are kind of contrarian, much like the Buffett purchase of Series, which we'll get into in a minute. But there's a lot of things that are being brought forward here. Now, when we look at the market cap relative to the overall stock market, we can see that we are pushing pretty extreme levels. We are surpassing the dot-com bubble. We are surpassing the 2008 financial crisis. And so these are levels that we really haven't seen in some time. And anytime you're bringing up those types of dates, it should definitely raise an eyebrow here and make you start thinking. Now, the third thing Goldman is pointing out is it expects the economy to contract more frequent for the next decade. Now, I tend to agree with this once again, because when we look at the consumer and how the consumer is diversified here, our jobs are based on services and government jobs, where those only work when the government is spending. And we see here that with government deficits reaching the heightened levels, could we see some frothiness in the job market? Could we see some unexpected moves in the consumer where the consumer is pretty much tapped out at this point in time? We're watching savings levels come down, we're watching debt pile up, and we're starting to see things like car repossessions start hit 2008 levels. And if the consumer is running out of steam, well, then we know the job market's eventually going to falter here because it is mainly based on the consumer consuming. And once that stops, a lot of these service jobs are going to go down, and that is going to cause unemployment to tick up. The fourth headwind that Goldman Sachs is seeing is corporate profitability. Are we going to see a lot of these big companies that are carrying the market slow down on growth, or possibly decelerate, which would then correct a lot of this market frothiness. The fifth is the relative level of the 10-year treasury, something we talk a lot about on this channel. Anytime I stated that the 10-year pushes above 4%, we're talking about a market pushing 30 times trailing 12-month earnings, and a forward P pushing 23 times, I definitely think there's an argument to be made for a 10-year treasury that is pushing above 4%. Everything that Goldman Sachs has stated in this recent article is everything I've stated over the last 12 months. And we've been a lot more contrarian on this channel. Now let's talk about the opportunities, or where I think you need to be looking. And let's use Warren Buffett's new purchase of Siri as the example, because this is fitting exactly into what we've been talking about. Sirius XM, 10% owner, Berkshire Hathaway. Warren Buffett bought 1.557 million shares at $26.50 to about $27.50 worth, approximately $42 million. This is almost nothing for a guy like Warren Buffett, only $42 million. But when we're talking about a small cap company, a company that is under a $10 billion market cap, a purchase like this, it definitely brings some eyes and moves the stock. So that is kind of where you have to be a little cautious. But let's dive into this stock and why I think he purchased it. Let me start out with two major things here. Number one, it does pay a dividend. Number two, the forward PE sitting under 10 times. These are two areas that we've been talking about on the channel. Now, if you're new to the channel, this is kind of where we've been putting our focus. We're looking for dividend growers, low valuations, and companies with competitive advantages. The reason why we're looking at this is because, as I've stated, I do think there's an opportunity for us to go into a recession. And I do think low valuations, dividend growers, and companies that have EPS growth will be the outperformers as long as the valuations make sense compared to their peers. That's kind of been my bullish thesis on this channel. Now, what are some other things that we've talked about the company has to do? Has to deploy capital well. So we already have two check marks from this purchase from Warren Buffett. Valuation seems very reasonable at under 10 times earnings, nice dividend yield. And next thing we have to look at is, are they deploying capital well? Are they getting over a 10% rate of return on deployed capital? ROIC is sitting at 18%. They are deploying capital extremely well. It's got a free cash flow yield over 10%, another bonus. Over a 10% free cash flow yield, deploys capital well, pays a dividend, trading at under 10 times earnings. You guys are starting to see what we've been talking about on the channel and why Warren Buffett might be interested in the stock. Net income margins are dominant when we compare them to their peers. Over 14% net income margins versus industry standards sitting at 2 to 3%. Dividend safety is sitting at a pretty good rate at C++. Dividend history, this is a company that has been paying a dividend for 7 years and growing the dividend for the last 7 years. So multiple reasons why I think this was an interesting purchase for Buffett. I definitely think this falls into his value territory and a company that could have some upside here. Are there some other things that I don't know about? Yes, I'll have to dig into some more. We'll probably run an analysis on this one, but I'm starting to see why this is clicking on pretty much everything that we've been talking about on the channel. Now, another area I want to touch on is going to be the health insurance providers here. We're watching a company like Cigna absolutely sell off here with the discussions of taking over Humana. Now, this has been a beautiful upward chart over the last 5 years. This is a company that has done a nice job. Problem with this company, once again, the same problem that CVS is having, the same problem that Humana is having, and the same problem that Cigna is technically having is this is a very, very low margin business. Cigna's been paying a dividend for 34 consecutive years and raising that dividend the last 3 years. But the thing I want to point out here is take a look at their profitability. We're talking about less than 2% margins here. Net income margins is sitting at 1.72. When we compare that to a CVS dealing with their own problems, theirs is sitting pretty darn close to that as well at 1.99. Now, CVS is dealing with some pretty serious problems here. They're switching up management. They're switching up their board. The stock's kind of fallen off of a cliff. I think there's tremendous value to be had if this is managed right. I still am bullish on this overall company. I think there's just too many areas that they could succeed in. Obviously, there's areas where they can fail, but I think a lot of what the insurers are dealing with here is a few different things. When we think about the baby boomers now cashing in, now wanting to be healthy, now retiring, there's less people paying into these funds and more people using the health insurers. So this is cost, and we see health insurance costs skyrocketing. multiple headwinds dealing with these companies. And so if margins are under pressure and that is taking place, then margins could actually go negative pretty easily when we're talking about 1 to 2% profit margins. So when we take a look at Cigna now wanting to merge with Humana, when we take a look at Humana's, they're sitting at 1.5. So we can see these are two businesses that would merge together to obviously compete with a United Healthcare, but the margins are still very, very compressed. And we're talking about a very low margin business that has multiple headwinds here. When we compare United Health's margins here, not only are they on a larger scale, but their margins are nearly double that of both Cigna and Humana. So, this Cigna-Humana merger is definitely interesting if there's some cost-saving synergies or if they're able to get the margins under control. But I've been betting on CVS, as most of you know, for an extended period of time, and it just seems like they can't get out of their own way. And I thought this was a great flywheel business model, meaning once you're on that flywheel, there's multiple ways that people could be sold, whether it's through their pharmacy, whether it's through using Aetna, a lot of the long-term care facilities that they were acquiring. I thought there was multiple ways that CVS can get the people on their technology platform and really interact with the consumer and being able to get that flywheel business model where multiple transactions could happen, and it's a pretty sticky business model. But they've just not been able to execute. And at this point in time, it would have to be dirt cheap for me to even think about re-entering this position. This is definitely one that I've gotten wrong, but even though I've gotten it wrong, I built enough safety in my analysis where I got out a little bit ahead and actually even on it. So it's been an underperformer in my portfolio, and I think I would possibly re-enter the position if it got below $52 again. That's where I think it might make a little bit of sense. But once again, that doesn't fix the margin problem and the management execution that still is on the horizon here. We don't know what is next for CVS, and I also think that unknown and the fact that they're kitchen sinking the next couple quarters and not giving any guidance is scaring investors, and they're closing down stores, and nothing good is coming out of CVS at this point in time. Nothing's really good coming out of a lot of these health insurers, period. So just to kind of go back earlier in this video, I agree that Goldman is onto something here with S&P decade of lost returns. When we start really comparing it to 2008, to the dot-com bubble, when we look at valuations, concentration, forward rates of returns, and we look at a yield, we look at a 10-year treasury now pushing above 4%, there's multiple reasons why I believe we could have muted returns in the future. This could play out multiple different ways, but of course this is my opinion, and the way we kind of get around that, or the way I think we get outperformance, is looking more for defensive sectors, dividend growers, EPS growth, good management in place, and you want that defensiveness, as I stated earlier. You want companies, whether we go into a recession or not, that are going to have pretty strong earnings. We've talked about healthcare, we've talked about consumer staples and names in those areas, and we've also talked about companies like Raytheon that I thought were very, very cheap, around $60 a share, up over 100%. Kroger that got into the 40s, now trading in the 50s. So these names do present opportunities. It's just a matter of running your analysis and figure out at what price point does it make sense for you as an investor. And so when we look at something like Siri, this one is definitely piquing my interest, not because Warren Buffett bought it, but because Warren Buffett brought it to my attention. This was actually a company I haven't really looked at, but I can see what he's seeing in this company just by scratching the surface. So this would be one that I definitely want to dive into and get a little nitty gritty on. I think valuation, low market cap, probably not a lot of coverage on it. Pays a dividend, growing that dividend seems pretty interesting overall, guys. So as always, guys, really appreciate your time. Let me know what your thoughts are on this Goldman letter. Do you think that stocks are still going to be on this big bull run for the next 10 years? Or do you believe that there's going to be muted returns in the future? As always, guys, we will see you in the next one.